Welcome, high-achieving candidates, to this rigorous explainer masterclass. I'm your subject specialist and senior examiner, and look, we are on a shared mission today. We're bridging that massive gap between basic data entry and real high-level financial intelligence. We're not here to just help you scrape by with the passing mark. We are here to mentor you step by step, right to that A-star grade in your IGCSE Accounting 0452 exam. Now, books of prime entry might sound like, just a simple record-keeping exercise. But as we're going to see, it is literally the architectural core of your entire accounting success. So let's jump straight in.
Okay, here's our rapid-fire roadmap for today's explainer. First up, we'll nail down the A-star conceptual blueprint. Second, we move into advanced technical execution. After that, we're tackling Assessment Objective 3, diving deep into ratios and evaluation. And finally, I'm giving you my direct examiner insights and strategy.
Right. Section 1, the A-star conceptual blueprint. This is where we lay the absolute foundational logic required for the upcoming syllabus.
Let's address a massive shift in the landscape right out of the gate, specifically regarding the syllabus 2028 to 2030 updates. Cambridge has moved firmly to modern international terminology. So what does this mean for you? You've got to use terms like irrecoverable debts, not the old bad debts, and owner's equity instead of just capital when you're writing out those longer answers. I honestly cannot stress this enough from a marking perspective. Using outdated terminology instantly tells us in the examining room that your knowledge is stuck in the past. Nailing this precise vocabulary proves you actually grasp the business entity concept, that vital idea that the business and its owner are completely separate, distinct things. If you want that A-star, your vocabulary needs to be 100% current.
Building on that entity concept, we hit a core architectural requirement, the accounting equation. Assets equal liabilities plus equity. It's like a giant seesaw. It must remain in perfect balance at all times during the fiscal period. But how do we know the numbers we're plugging in are actually right? Well, that is where the prudence concept and historical cost principle step in. They're your architectural bridge. We routinely have to dock marks when students overstate profits because they simply ignored potential losses. Prudence dictates we must always anticipate losses, never profits. By strictly recording assets at their historical cost, not what we optimistically hope they're worth today, we completely prevent overstating profits. This keeps everything totally transparent for banks, owners, and tax authorities.
Moving right along to Section 2, Advanced Technical Execution. This is the mechanical heart of the exam.
We need to master this advanced technical methodology. This is your non-negotiable procedural flow for extracting maximum marks during complex calculations when that clock is ticking down. Step 1. Identify the correct source document, like an invoice or credit note. Step 2. Record it in the correct book of prime entry. Step 3. Post it to the ledger T account. Why is this explicit procedural logic so vital? Because method marks are your absolute safety net. Listen closely. Even if you completely botch the final balance because of a panicked split-second calculator slip, we examiners will still award you those crucial method marks if we can visibly track your logical flow. So never ever skip documenting your steps. Show your workings.
Now we arrive at the gold standard of double entry, the T account. And I am issuing a major examiner warning right now. You absolutely must flawlessly differentiate between balance C/D, which is the carried down balance at the very end of the period, and balance B/D, the brought down balance starting the new period. Getting these flipped is an absolute tragedy on exam day. And while we're talking about traps, you have to be hypervigilant about the math behind trade discounts versus cash discounts. Trade discounts, they're deducted immediately, before anything even touches the ledger. Cash discounts, though, are recorded separately as expenses or income. Do not mix those two up.
Look, we know exam pressure is intense. Even brilliant candidates can suddenly blank on basic double entry rules. So I'm giving you a vital memory hack to guarantee perfect formula application every single time. Dead click. Keep this locked in your brain. Literally write it at the top of your rough paper the second the exam begins. DEAD stands for debits, expenses, assets, drawings. CLIC stands for credits, liabilities, income, capital. If you freeze up while balancing those ledgers, dead click instantly reminds you of the normal balance side for every single account type. It is an absolute lifesaver.
100%. That's it. That is your non-negotiable target accuracy rate for the trial balance phase. A perfectly balanced trial balance is the definitive mathematical proof that your prime entry and your double entry execution were completely flawless. Hitting this 100% accuracy gives you massive psychological relief during the exam. It lets you transition seamlessly and completely stress-free into drafting your final financial statements, totally confident that your foundation is rock solid.
Shifting gears now to Section 3, Assessment Objective 3, Ratios and Evaluation.
This is the battleground for A-star candidates. Simply calculating a ratio is baseline. It's an expected skill. Interpreting what that ratio actually reveals about the real-world health of a business, now that defines excellence. Imagine an exam scenario where a firm's current ratio plummets. It drops from a highly comfortable 2.5 to 1 in year 1, straight down to a terrifying 1.1 to 1 in year 2. When an A-star candidate sees a liquidity freefall like this, they don't just write a sentence stating, "The ratio dropped." No way. They instantly trigger a rapid-fire mental debate, dissecting exactly why that liquidity completely collapsed.
Let's debate that cause and effect chain together right now. Did the business wildly overpurchase inventory that's just gathering dust in a warehouse, tying up all their cash? Or maybe trade payables are being settled way too slowly and toxic short-term liabilities are mounting up fast. What if their cash reserves were just entirely wiped out by a massive capital expenditure, like deciding to buy a brand new factory out of current operational funds? Demonstrating this precise level of analytical troubleshooting and debating multiple viable causes, that is exactly what I'm looking for to award top marks in high-level evaluation questions.
Now, what happens when you try to compare two entirely different firms directly against each other? That is a classic AO3 trap. Contrasting accounting policies can make direct interfirm analysis dangerously misleading. Let's say Firm A uses the straight-line method for depreciation, aggressively writing down assets, while Firm B uses the reducing balance method. Without deeply understanding those differing policies, you literally cannot accurately compare their operating profits. It's apples and oranges. You have to proactively point out these differing accounting policies in your final written evaluation. Spotting that limitation is top-tier investigative skill.
Furthermore, evaluating the true quality of a profit requires stepping entirely outside the ledger. Accounting records have severe limitations. They are completely blind to vital non-financial sustainability factors. What is the actual state of staff morale? Are they operating in a location that's rapidly declining? Has their market reputation taken a massive hit? These qualitative things simply don't show up in a T account, but they absolutely dictate the long-term sustainability of the firm's return on capital employed. An A-star answer always weaves at least one non-financial factor into the final evaluative paragraph.
Finally, we reach Section 4, Examiner Insights and Strategy. Time for the final polish. Consider this your pragmatic exam day survival checklist straight from the principal examiner reports. First, a harsh reality. If I cannot read your handwriting in the ledger accounts, I cannot give you the mark. Writing a sloppy, balanced CD is just a tragic way to lose easy points. Second, do meticulously distinguish between revenue expenditure and capital expenditure. Capitalizing a routine vehicle repair instead of treating it as an expense, that is a fatal flaw. It's going to completely unbalance your asset registry and your profit. And lastly, don't ignore specific question weightings. Allocate your time based strictly on the marks available.
To bring everything we've talked about today firmly into the real world, let's look at a modern industry application requested by the research directive. Everything you are learning about books of prime entry right now is being revolutionized by modern fintech. AI-driven accounting platforms, like Xero, heavily automate this exact process. Invoices get scanned, machine learning flawlessly extracts the data, and the double entry is executed instantaneously. But does this automation make your syllabus obsolete? Absolutely not. Actually, it proves exactly why high-level conceptual understanding is more relevant than ever. When machines handle the data entry, humans are still required to interpret the results and enforce the conceptual framework.
Which brings us to our final provocative thought, your pause and think A-star challenge for this explainer. If AI entirely automates the books of prime entry, how does a human auditor step in to actually verify that the prudence concept was genuinely applied to an irrecoverable debt? Think carefully about that. AI follows programmed rules, but deciding if a specific debt is truly irrecoverable requires human judgment, deep economic context, and the ethical application of accounting principles. Ponder that as you review your notes. Mastering the mechanical entry is just the baseline. Understanding the critical why behind the mechanics is your ultimate advantage. Keep pushing hard for that A-star, and I'll see you in the next masterclass.